Hello, good morning. Welcome to the Mortgage Rate Forecast with Scott Criss, your mortgage rates and news. It is August 10th, and hey, let's get started with charts. You can see we have a pretty nicely developed upward trading channel going on here. This has been going on since late June. Currently still tracking the 3.5 coupon. Bonds are trading at 103.31 this morning. We're seeing support come in below us. Sorry, I wanted to show you the upward trading channel because it's pretty well defined at this point. But our support's coming in below us at about 103.20, which is right here if you look at my mouse, and then again below us even further at 103 even. Our resistance is going to be all the way up here at about 103.50, which we haven't hit that since early June. So here's what we got. Jobless claims came out worse than expected, higher unemployment rate than projected. So that's helping out the bond market. Plus the PPI came out and there's no inflation. So this is really good for bonds because if you look at it from an investor perspective, if you're only going to be making 3%, let's say, and inflation's 1%, well, technically on a 3% investment, you're only making 2%. Because 1% is inflation, so that's the loss of the value of the dollar. So with no inflation, that's actually really a good sign for bonds as well. So bonds are actually trading really well. A lot of that, though, is, really not just the economic reports, but North Korea. It has caused a little bit of unrest in the markets, not just in the U.S., but also internationally. So we're going to see a little unrest in the stock market, which is going to mean better bond markets. So we could see this run continue. Even the stocks Europe 600 is down 0.5%. So anyway, get ready for that. To kind of quantify where we're at, Freddie Mac reported in June, sorry, they have not released their July yet, but June, the average consumer received a rate of 3.9% and paid 0.5 point to get there. So if bonds were trading back then at about 103.20 and currently we're trading at 103.31, that's 11 cents better, which means the average consumer, instead of paying 0.5 point, is probably going to pay not a lot, but a little bit less. So anyway, that's really good news to the consumer right now. But let's, what's the forecast? What's the projection? Are bonds going to get better or worse? Well, the analysts are pretty bullish right now on the short term. So in the next couple days, they think we could continue to see some growth. So that's good. I did miss my last projection, by the way, by 14 cents. Bonds are about 14 cents better today than I had estimated. So it's a miss for Scott, but it's in your favor. So that's a good thing. Nonetheless, here's what we got. My new forecast, I'm going to say the bond range is going to be between about 103.10 to 103.50 through next Thursday. So that's a fee swing of about 19 basis points, or 0.2 of a point, to the better, or maybe 21 basis points to the worse. Not a lot of big swing though, guys. And I'm with the analysts on this one. I think short term we could actually see a little bit of improvement, but man, I'm telling you, 103.50 is a really big mark to hit, and I think it's going to be pretty tough for us to break through that. Anyway, that's where we're at for now, but we'd love to hear your thoughts. Leave your comments down below, and everything likes to be liked, so does this video. So, and if you want to subscribe, click that guy at the top left. That will get you a little alert when we upload new content. And if none of this made sense to you, it's okay. At the top right, there's going to be a video called Mortgage Bonds 101, and it'll teach you the basics that you need to know as a consumer when you're trying to pick out the best time to lock in your interest rate. Anyway, that's it for now, guys. We'll see you next Thursday. Have a great day. Bye-bye.